As of the market close on Friday, January 9, 2026, SMX Security Matters plc, trading under the ticker SMX on the NASDAQ, sits at a price of 23.11 USD. This represents a sharp intraday drop of 5.05 USD, or about 17.93% from its previous levels. While the market is currently closed this Sunday, January 11, 2026, the volatility we saw during the final hours of the week tells a story that most retail traders on a Fidelity trading platform or a Robinhood app might find unsettling. On the surface, you see a massive percentage drop that looks like a typical penny stock collapse, but the reality is far more complex. The immediate insight you need to grasp is that this 17% slide wasn't just a random sell-off, it was the market pricing in the massive dilution from the full conversion of over $20 million in convertible notes. Most investors were watching the triple-digit percentage gains earlier in the week, thinking they had found the next NVIDIA stock or a hidden gem in the circular economy sector. They expected the momentum to carry the price toward the moon, but the reality is that the company just flooded the market with over 1.2 million new shares to wipe its debt clean. When you look at your individual brokerage account and see a red candle that deep, the natural instinct is to wonder if the tech is broken. The common expectation for SMX is that its molecular marking technology is a goldmine for ESG and supply chain transparency. People believe that because the company can mark a piece of plastic or a gold bar at the molecular level, every major manufacturer will soon be knocking on their door. That is the bull case you hear on social media and across various investing sites. However, the contrarian view, and the one the market is currently voting on, is that a company with zero revenue and a price-to-book ratio north of 140 times is in a desperate race against its own burn rate. While you might be tempted to treat this like a self-investing play similar to how people trade Tesla stock or Apple stock, the risk profile here is in a completely different category. The recent movement has been nothing short of a roller coaster. Just days ago, SMX was surging over 70% in a single session. This volatility attracts a lot of attention on platforms like Interactive Brokers and SoFi Invest, where active traders look for high beta movers. But look at the volume. We saw over 16 million shares trade hands on some days, which is nearly 8 times the 20-day average. This isn't just retail enthusiasm, it's a battleground between institutional short sellers and momentum chasers. When the company announced on January 8 that it had cleared $20.6 million in debt, the initial reaction from some was positive. Clearing debt is usually good, right? Well, not when it comes at the cost of massive dilution to existing shareholders. It effectively eliminated the debt overhang, but replaced it with an equity overhang. If you are using tools like Schwab Intelligent Portfolios or a SoFi robo-advisor, you likely won't see a stock like SMX in your automated holdings because it fails almost every traditional stability metric. The current ratio is a staggering 0.08, meaning their short-term obligations vastly outweigh their liquid assets. This is why the stock is behaving so erratically. Every time there is a bit of good news, like the expansion of their rubber glove traceability program or a new pilot in the cannabis industry, the market tries to rally, but the structural reality of the balance sheet pulls it back down. Traders using Interactive Brokers trading tools are seeing these technical patterns where the stock fails to sustain any breakout above its 200-day moving average, which is still miles away from the current price. Let's talk about what this company actually does for a moment to put the price action into context. SMX integrates chemistry and computer science to give physical materials a memory. They use a submolecular marker that can be read by a proprietary scanner. Think of it like a permanent invisible barcode that stays with a material from the moment it's created until it's recycled. They've recently pushed into the latex and rubber glove market, which is a massive waste stream. The hope is that by marking these materials, they can verify recycling claims and help companies meet new environmental standards. It's a compelling story, which is why it gets so much traction on online investment forums. But a story doesn't pay the bills. According to their latest filings, they are still struggling to turn these pilot programs into meaningful, recurring revenue. For those of you managing your own Fidelity investments or using Fidelity mutual funds, you know that fundamental value eventually wins out over hype. Right now, SMX has a market cap around $36 million, but they've lost over $40 million in a single year. When you compare this to the stability of a Fidelity wealth management portfolio, the contrast is jarring. You have to ask yourself, am I buying a technology or am I buying a financing vehicle? Lately, SMX has looked more like the latter. The full conversion of those notes in December and January was a necessary evil to keep the lights on, but it serves as a reminder that in the world of online investing, the first mover advantage in tech often comes at the expense of the early shareholders who get diluted into oblivion. Comment below how many shares of SMX you currently hold, or if you are waiting for a more stable entry point. It's important to see where the community sentiment lies on these high-risk plays. Looking at the institutional activity, we haven't seen the big players like Fidelity IRAs or major Fidelity ETFs piling into this name yet. Most of the action is coming from smaller hedge funds and day traders using the Robinhood mobile app or SoFi active investing accounts. This lack of institutional support is a red flag for long-term holders. When big banks and asset managers stay away, it's usually because the risk of a going concern warning, which SMX has already received from its auditors, is too high. They are literally fighting for survival while trying to scale a technology that is still in the proof of concept phase for many industries. If we look at the sector momentum, the industrial and specialty business services sector has been relatively stable, yet SMX is moving 20% to 50% in a day. This disconnect tells you that the stock is decoupled from the broader market. It doesn't care what the S&P 500 or the NASDAQ are doing. It only cares about its next capital raise and whether it can land a contract that actually includes a dollar sign with a few zeros at the end. For someone looking for investment help, a financial advisor would likely tell you to stay far away from this until they show a single quarter of positive cash flow. But for the self-investing crowd on Robinhood stock trading, the lure of 100% gain in a week is often too much to resist. The tension here is between the expectation of a green infrastructure boom and the reality of a company that is essentially a micro-cap R&D lab with a public listing. Investors expect that because governments are passing stricter recycling laws, SMX is the natural winner. The reality is that there are other players in the traceability space, and many of them have better capitalized balance sheets. Even if SMX has the best marker technology, if they run out of cash before they can scale, the technology will end up being bought for pennies on the dollar in a bankruptcy auction. This is the reality that the recent 17% drop is starting to reflect. The market is realizing that the $20 million debt conversion wasn't a sign of strength, but a sign of a company clearing the deck because it had no other choice. If you are using the Robinhood trading platform or using Robinhood fractional shares to build a position, you need to be aware of the penny stock rules. Because the share price has been so volatile and historically low, brokers have to follow more stringent rules, which can lead to lower liquidity. Lower liquidity means when you want to sell your shares during a crash, you might not find a buyer at the price you want. This is why interactive brokers' fees and their professional-grade execution tools are often preferred by people trading these types of names. They need the speed and the access to more liquidity pools than a standard retail app might not offer. The business model of SMX relies on a plastic cycle token and a digital ledger system. They want to create a marketplace where companies can trade credits for using recycled materials verified by their molecular markers. It's an ambitious plan that overlaps with what we see in some Robinhood crypto offerings or other blockchain-based investments. But again, the infrastructure for such a marketplace doesn't exist yet in a regulated, mainstream way. They are trying to build the marketplace and the technology at the same time, all while being nearly broke. It's like trying to build a plane when it's already in the air and you're running out of fuel. In the final section of our analysis, we have to look at the future outlook. What are the catalysts? The obvious one is a partnership with a major global brand, someone like a giant in the rubber or textile industry, that goes beyond a pilot program. If they can move from testing to integration, the revenue would finally start to justify the valuation. But the risks are equally massive. Another round of dilution is almost certain. They have a history of 7 stock splits, which is a classic sign of a company trying to keep its share price high enough to stay listed on the NASDAQ while its actual value erodes. If you're looking for online investing opportunities, you have to weigh that history heavily. So where does that leave us? The expectation was that the debt conversion would unlock the stock's potential by cleaning up the balance sheet, but the reality is it simply highlighted how much the company has to rely on issuing shares to stay afloat. For the active trader on the SoFi trading platform, this is a great vehicle for volatility, but for the person looking for a solid investment, it's a minefield. You are essentially betting on whether their 100+ patents can be sold or licensed before the company runs out of options. In summary, the